forget complicated strategies, Fibonacci retracement can be your easiest go-to tool for spotting price reversals. Whether you're new to Forex or a pro, mastering these tools is like having a trading cheat sheet. But if you're using it wrong, you're probably leaving profits on the table, or worse, making avoidable losses. Now, I've been there, wasting time, overcomplicating charts until I figured out how to use Fibonacci retracement effectively. And today, I'll share my approach with you in less than 5 minutes. So let's get straight to the point. What is Fibonacci retracement? Fibonacci retracement tool is a technical analysis tool used by traders to identify potential levels of support and resistance in a financial market. And it's based on the mathematical ratios derived from the Fibonacci sequence. But I don't want to focus on the history. I want to focus on how you can use it so you can be a better trader. So why do traders use Fibonacci retracements? 2 simple reasons I'm going to focus on. Identifying support and resistance levels. Fibonacci levels act as areas where the market might react, might pull back to, or extend to. Or secondly, predicting market pullbacks, my favorite way to get traders into the Fibonacci game. See, after a significant price movement, the market often retraces before continuing its original direction. And now you can hear it in the word. Fibonacci retracement, pullback, helps traders anticipate where this retracement might end. So let's get straight to the chart. I've got the euro dollar. Now, I don't know how confident you are with the charts right now, but charts are very, very easy to understand. If you see lots of reds, you see lots of sellers. If you see greens, you see buyers. Now, right now, we can see just on this chart, we've had lots of sellers come down to this price level. Now, markets can always pull back and then continue in its overall trend. So let's say euro dollar here has now reversed. Okay, we can see the structure broken, which simply means that the trend line here, or this, could be known as a breaker structure. There's many, many reasons why, how people interpret this. People call it a breaker structure. People call it a reversal area. As you can see here, we have a higher high, higher low, higher high, and now a lower low. So theoretically, the next thing is the market could retrace to any one of these Fibonacci levels, which could act as a resistance and then continue back down. So essentially, it's helping us with its pullback. Now, the key thing you need to understand, it's subjective. Yes, it can be subjective. Someone can draw it one way and somebody might draw it another way. You might go on YouTube and they say draw it this way, while someone on another platform or a blog or on social media might say draw it this way, and you might notice that I might be drawing it a certain way. So I need you to keep in the back of your mind that Fibonacci is a very subjective tool, and now I want to focus on finding you an easier way on how you can use it and why you can use it. So let's go drop to the whiteboard, right? Now, most of you understand market structure, right? Market can go up, go down, it goes up, it goes down, it goes up, it goes down, it goes up, it goes down, it goes up, right? And on the other side here, market, let's change the color, okay? It goes down, up, down, up, down, up, down, okay? So some people identify these as higher highs, higher lows, and this is known as market structure. Higher high, higher low, higher high, higher low, higher high, and higher low. Okay, and that's made a higher high there. Now, if we come to this side, this is now made a lower low, lower high, lower low, lower high, lower low, lower high, and a lower low. And I'll show this on the chart as well. So, look. Many people can call this many things. We like to call it phase 1 or a phase 2. So phase 1 goes in the direction of the trend. Phase 2 is a pullback. Hear the word pullback, retracement, pullback. Phase 1 goes in line with the trend. Phase 2 goes against the trend. Phase 1 goes in line with the trend. Phase 2 goes against the trend. This is how the easiest way to remember it. 1 and 2. 1 always goes in line with the trend. 2 always goes against the trend. 1 is always longer than the other. So some people might call that an impulsive move. Some people might call that an extension to the upside. Someone might call that buying momentum. We just call it phase 1 to the upside. And if the market pulls back, it's phase 2. Now, where most people get confused is they want to know is how do we know where the market could pull back? Right? Because logically, the best place to trade is going to be the beginning of a phase one, isn't it? Because that's the move that's going with the trend. That's the move that's going with the trend. So you want to trade with the trend. You want to increase the probability to go with the trend because the trend is your friend until the bend. So let's just keep it simple now. So now most people say to me, well, how do I know where the pullback's going to be? So I can plan or organize myself or prepare for the next move to the upside. The same thing for a downside, right? But let's focus on the upside. So in this case, this is where you will use Fibonacci retracements, because then you will have potential levels to where the market could retrace to. So then you can focus on catching the next move up. Right? You're getting it. You're like, okay, well, that makes sense then, because we know about higher highs, we know about higher lows. The market's going to go up, then it's going to go down. So when it pulls back, we can use Fibonacci retracement then. But yes, so which level is it going to be? I know that there's levels. There's 23.8, 61.8, 50%. What's the best level? I get it. But like I said in this video, I'm going to show you the simplest way to use it, and then you can start leveling up on it. Because like I said, Fibonacci is subjective, and some people tend to overcomplex it, while I like to simplify it. So remember, if we can get better identifying trending markets, it gets very, very easy. Let me explain. So I'm just going to head over to Euro Dollar now, and I'm going to head over to a daily time frame. Okay? I'm going to head over to a daily time frame, and let's just get rid of this Fibonacci here. Now, as we can see on this daily, okay, we can see the market has been trending beautifully to the downside here. So let's just take this scenario here, and I'm just going to highlight this area of this trend. Let's make sure you can all see it by removing the fill. Now, just take a second, look at this chart, and you can see that the market's made phase ones going down, made phase twos, phase ones, phase twos. And again, people might read it very subjective. So let's focus on the easiest part to read at the moment for this example. Okay, so let's now dive down into this part here, and let's zoom in a little bit. Now, as we can see here, ladies and gentlemen, this has made a phase one, phase two, lower, so a lower low, lower high, lower low, lower high, lower low, right? A lower high and a lower low. Okay. Now, in this example, where would you draw the Fibonacci retracements? Don't worry about where to start. We're going to go to, and again, you can do this on any platform you're using. Every trading platform has Fibonacci retracement. I like to use Smart Charts, just my preferred trading platform. So as I go on Fibonacci retracement here, if I'm focusing on a downtrend, I want to go from high to low. Okay. High to low. In an uptrend, low to high. I'll show you both examples. So if I go from here to the end of the trend here, do you see how the price, let me just show you this. Can you see how the price retraced back up to these resistant levels? You see that? 38.2, which is a Fibonacci sequence number, and went near the 50%. Now, I'm not talking about how to trade off it yet. Not talking about how to trade off it yet. What I'm focusing on right now is just how to use the tool. Just how to use the tool. Now, as you can see, okay, markets retrace. If it comes off this area, we could see another move to the downside. Brilliant. And market goes all the way here. Now, I know what you're probably saying. You're going to say, well, how do you know where it's going to extend to? Don't worry, there is another tool, and that tool is called Fibonacci extensions, but we'll focus that on another video. So now, as I draw another Fibonacci down here, from the high to the low here, can you see how the market has been resisting off that 50% level? So did the Fibonacci give you an area or a level or a resistance, or helped you identify where this market could pull back to? Yes, it did. And then market moved to the downside. And again. So you want to use these in the phase ones. Again, you can see the market came to the 78.6%. And then the market came down, and then again, you can keep drawing it in these scenarios of phase ones down. And as you see here, market came up to that 61.8. Now, if we look carefully as I zoom out now, do you see how the Fibonacci gave us levels to where the market could pull back in this trend? Let's zoom out a little bit more. But it's subjective, right? What if someone draws it like this, from this high to this low? We can also see, look, the market has come to that level of 38.2. So this is where it can get really, really messy. So the first thing you need to do is being able to identify a trend. And the easiest way you can do that is with moving averages. So let me show you. So Fibonacci alone can be great. Many traders start changing time frames. The key thing you want to do is just identify where the market can pull back so you can speculate where the next move is going to, which is in line with the trend, which we call phase one, or you can call an extension up or an impulsive move up or down, depending on the trend. Now, there are many, many ways you can use Fibonacci. So let's just say I use the daily here, and let's pick a weekly time frame. Again, it will vary on different time frames. So if we just look at this, this looks like a very extensive move to the downside, all the way from half September all the way to now January. So we can see the market move. Now, it's very subjective. See, a trader might draw it from here to here and say, I expect an overall pullback to any one of these levels. That's all it's saying. It's saying using a mathematical sequence, the market could pull back to these levels. But what if I draw it from here to here? We can see the market now has come to a Fibonacci level of 78.6%. Can you guys see that? Which theoretically, in theory, we could be speculating another move down. Now, again, we're not focusing on right now how to identify the next move. We're focusing on just how to identify where the pullback could go using the Fibonacci's. So you need to get better at reading cycles or market structure, however you want to define it. And as you can see, every time the market pulls back, the Fibonacci's can give us indication to where the market might resist on a downtrend or support on an uptrend. All right, let's show you on an uptrend, because I've been focusing on downwards market. Let's just say we take this move here. From low to high, you can see market pulled back to the 50% and the market extended up. So you can use these as areas to give you an indication of what can happen next. Now, one little tip I like to use here is price alerts. Okay, so if you go price alerts, and let's say, for example, I've just put the price on here, and I think market's going to come to here at the 78.6, might bring it slightly lower. But if the market gets to that level, I'm not saying I want to trade off it. Hey, alert me that price has come to that level so I can begin to organize, plan, or prepare so I can perform in making potential profits in the financial markets. So like I said, I'm going to show you with what it's like with moving averages, and that can help you. So I'm just going to start with something very similar, I'm going to start with something very easy, the 20 EMA, and we're going to put it on the daily time frame. So there's the 20. Let's put it on the daily time frame, and let's just look at another currency pair. Let's look at GBP USD maybe. I like to look at the majors. So as you can see here, one thing you'll notice about moving averages, and we will do a video about moving averages and how easy they are to understand, and what they're technically doing is just visually representing the average of the trend that we choose to analyze. Let that sink in. Is that every time the market pulls back to the moving average, in a downtrend, it can act as a resistance. In an uptrend, it can act as a support. So as we can see here, every time the market pulls back, that is also acts as an area where the market could retrace to. But as you can see here now, every time the market extends off, you can use that. Every time the market extends off, down, and these will basically become your areas in helping you where the market could go next. So now if we see that the market is reversed, we can go from here, and what we're anticipating is that the market could pull back to any one of these levels. Okay, but then you're like, look, which is the best level? I heard the 50%. If the market always retraced to the same level, then I would have automated it, take super duper loans out from everywhere, ran it on an AI system and made lots and lots of money and not be talking to you. Think about it. The market isn't always predictable. The Fibonacci is doing it based on patterns. All right, and if the pattern was always predictable, then everybody will be making billions off the markets. Let's be real. You need to understand how to use this with other tools. So like incorporating it with EMAs. But what I'm going to tell you this, once the market gets to these levels, then you can add things like divergence. You can add things like candlestick patterns. You can add things like stochastics and combine a mechanical system using higher time frame and lower time frame with structure analysis to increase the probability for you to get to the upside. Last but not least, I want you guys to have a little tip here. Grab a monthly time frame. Pick any chart. Let's pick the euro dollar here, for example. I don't know, let's pick Aussie dollar. And a little exercise what I want you to do, just while we close off now, is I want you to put a Fibonacci on last month's high and low. So if we're in a downtrend, right, just get in the habit of going last month's high to last month's low. And as you've noticed, when you go down to the lower time frames on the daily, you see that the market retraced at the 38.2% level. Again, very subjective. You can do that as a little exercise just to identify where the market could retrace to in the following month. So the purpose of Fibonacci retracement in trading, the primary purpose of Fibonacci retracement is to provide traders with a systematic way to analyze price action and make informed decisions. And by identifying potential reversal points, traders can align their strategies with the natural rhythm of the markets. Now, if you want to learn more about spotting candlestick patterns, watch this video here and I'll explain the best candlestick patterns you can begin with.